As earnings season comes to a close, this is part 2 of my To Buy or Not to Buy series. I covered the state of the US economy in the first part, so check that out for some commentary there. I want to dive right in to my buy prices for this video, so cue the intro. Welcome to The Quality Investor. Today, we are looking at 5 more businesses and what their buy price is, with a margin of safety, of course. Each of these businesses had strong quarters. The more capital-intensive businesses are investing in CapEx spend for the future, and a case can be made for strong future growth for each. So, without further ado, we are going to review the buy prices of the following businesses: Apple, Intuit, Nvidia, Google, and Fair Isaac. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Here are the 5 businesses we are looking at today. The salmon colored rows indicate it is a stock I do not own in my current portfolio. And just like before, we have the market cap, the price, the buy price, the percent difference to get to that buy price, and what the implied free cash flow growth is based on the current market price. What is the market implying the free cash flow has to grow over the next 10 years to justify this price? We're starting with Apple. Apple had the weakest quarter of the 5 businesses on this list today, but they are showing signs of getting back to growth. Their current price is at $203.92, and I have a buy price of $180. The stock needs to fall about 11.75% to get to that buy price. To justify the current price in the market is pricing in free cash flow growth of 7.06%, based on a reverse DCF. For my base case free cash flow growth for Apple over the next 10 years, I actually have it growing just under 8.5% annually. And without a margin of safety, I have a buy price for Apple of $221, but with about a 20% margin of safety, that is where we get today's buy price. Remember, we always have to factor in a margin of safety. So I'm actually a little bit optimistic on a free cash flow growth basis than the market is currently. Apple indicated that tariffs are not actually affecting the business. They saw Apple iPhone growth of 2%, but none of that was demand pull forward due to tariffs. They are also shifting much of the manufacturing for iPhones, the phones bound for the US at least, to India and Vietnam away from China. But China does remain as the main manufacturer for non-US bound products. The real growth driver for Apple, however, is not the iPhone, but Apple's services. That does remain a bright spot, has double-digit growth in the paid subscriptions, and it has an incredible gross margin of 75.7%. Apple's closed ecosystem provides a massive network effect for the business, and as services continues to scale, they will use their massive operating leverage to continue to grow margins. Next, we have Intuit. Intuit had an outstanding quarter. I covered that in detail in my video on Intuit's quarter. Their current price is at $771.58, and I have a buy price of $710. The stock would need to drop about 8% to get to that buy price, and the market is pricing in free cash flow growth over the next 10 years of about 11.7%. On a base case for Intuit, I'm actually projecting over 15% free cash flow growth over the next 10 years. My buy price is actually based on a 20% margin of safety. Intuit, in my view, is a very safe business, and if you use a 10% margin of safety, their buy price would be $800, and actually right now would be a good time to buy Intuit. Intuit shines because they have a monopoly over small business accounting software as well as tax filing software. They operate with huge gross margins in this space of over 75%. And now that most revenue is derived from subscriptions for Intuit, as well as their dominant market position, they have the holy grail that you want in a business model, and that is pricing power. And that's what they cited for their outstanding fiscal Q3. In their QuickBooks segment, they cited higher effective prices, as well as customer growth, and even a shift into their higher priced offerings. So Intuit has a bright future ahead, and this is an excellent business, and I expect much more growth in the future. Next, we have the incomparable Nvidia. Nvidia currently has a price in the market of $141.72. My buy price is at $125. Nvidia would have to fall nearly 12% to get to that buy price. Nvidia, yet again, had another outstanding quarter of growth. They had 70% year-over-year revenue growth. They saw nearly 50% growth in their operating income and nearly 60% growth in their free cash flow year over year. Nvidia continues to dominate. They show no signs of slowing down. And this year alone, I am projecting nearly 50% year-over-year growth for the year as a whole. Nvidia also operates with incredible margins, with operating margin this fiscal year expected to be at 61.5%. So it is no wonder that the market is pricing in nearly 16% annual free cash flow growth over the next 10 years. And on my own base case, DCF, I have free cash flow growing for Nvidia at nearly 15%. I'm actually using a 20% margin of safety for Nvidia because in my own opinion, I can see the types of chips that Nvidia is making becoming commodified over the next 10 years or so as other businesses catch up in technology. Nvidia CEO Jensen Huang has emphasized that their AI chips are still in high demand. The supply constraints have eased slightly, but they're still tight due to the insatiable enterprise and cloud provider appetite, as you'll see with Google next. And while Nvidia has got a little bit of a break from tariffs due to some chip exemptions by the Trump administration, they still face tariffs from steel and aluminum that are required for data center hardware. But until competitors catch up with Nvidia, Nvidia will remain a strong leader in the AI chip market and will undoubtedly remain one of the biggest businesses in the world. Next, we're looking at Google. And in my view, Google is probably the most undervalued big tech firm in the market. Their price has been on the climb as of late. They're at $173.68. But my buy price remains at $200, which means they have about a 15% undervaluation right now. The market is implying only 6% free cash flow growth for Google over the next 10 years. That seems paltry given what they've been doing. Now, obviously, we cannot rely on historical trends continuing, but in my base case DCF, I'm actually projecting nearly double what the market is projecting in free cash flow growth at 12.3% over the next 10 years. I think Google will benefit mightily from margin expansion due to the Google Cloud platform. The Google Cloud segment saw 28% year-over-year growth, as well as massive margin expansion there. Cloud's operating margin now sits at 17.8% compared to 9.4% in the same quarter 1 year ago. This is only going to get better as Google Cloud continues to scale. Google Cloud is projected to have a $120 billion run rate in 5 years, and that alone can push it to a $1 trillion valuation just for that segment. Google also owns the largest streaming platform in the world, YouTube. It is in fact larger than Netflix. And when factoring in YouTube subscriptions, the Q1 2025 revenue for the YouTube segment is estimated to be between $11 to $12 billion. And just for comparison's sake, Netflix's Q1 revenue was at $10.5 billion. But for some reason, the market just cannot get over Google search. The market keeps dropping Google because of the tiresome belief that search is dead. Yet search continues to see double-digit growth, and their AI overviews are now reaching over 1.5 billion monthly users. Search certainly won't grow as fast as what it used to grow, and depending on the publications that you believe, Google seems to be leading in the AI race with their Gemini model. But search is now just one part of a very large conglomerate, and the other parts of this conglomerate are growing faster than search, which is going to be creating more value as a whole for Google going forward. And finally, we have Fair Isaac of the famed FICO score. Fair Isaac has come under political fire recently as Bill Pulte, the director of the Federal Housing Finance Agency, has raised concern about the pricing for their credit scoring. This prompted massive sell-offs in FICO stock. Right now they're trading at $1,775.10, but that is a rebound from when these attacks were initiated in mid to late May, and the stock fell from over $2,200 a share all the way down to $1,500 a share. But despite that fall, FICO is still a little bit rich for me. I have a buy price for FICO at $1,325. They've seemed to grown far faster than what their free cash flow is justified. That is my opinion. I think they're a great business and they have a great future ahead, but they, in my view, are way overvalued at the moment. They would have to come down another 25% to get into my buy range. The market is pricing in nearly 20% free cash flow growth for FICO over the next 10 years, whereas I have a base case free cash flow growth for FICO at just under 16%. Certainly amazing growth, but I don't think FICO's growing anywhere near enough to justify their 76.4 PE ratio. I do think these attacks on their credit scoring pricing are overblown and will be forgotten here in a few weeks' time. And FICO has an incredible monopoly over the credit scoring system in the United States, but at the current valuation, it's very tough for me to justify even considering buying right now. So that wraps up the 5 businesses for today: NVIDIA, Apple, Alphabet, Intuit, and Fair Isaac. 4 of these 5 are a little bit rich for me right now. Google is still at an excellent valuation. However, I'm going to be holding off buying more Google simply because it is already a very large part of my portfolio, and I don't want to increase its overall weight in my portfolio. I will be doing a part 3 to the to buy or not to buy series here later this week as I cover 5 more stocks and their buy prices after the Q2 earnings season. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.